Joining us today, Chintan Patel from KPMG India. We also have Nidhesh Jain from Investec Capital Services joining in on the show. Gentlemen, morning. Good to have you on the show. Chintan, if I could start with you, what are the broad trends that you are seeing when it comes to real estate, and what really could be the future of the sector at a time when work from home has become a reality? Could we see significant pressure come by, at least on the commercial real estate leg of the industry?
Sure. Firstly, thank you for having me over. And I think real estate across the spectrum, across all asset classes, is going to have a slightly tougher time in the next 12 to 18 months period. Residential was anyways in a slightly tougher spot even before we got into COVID. Commercial real estate was one of the green shoots that real estate had. But with what's happening from work from home and the whole somewhat decline in demand with absorption going forward as companies try to focus more on their core business rather than just expanding, that may have some impact on commercial real estate. However, I'd not be too kind of eager to jump on the bandwagon that commercial real estate is going to be doomed because of work from home. Because I think the way trends are shaping up, while currently people are working from home, but would this be a long-term norm, or would it be a quasi pre-vaccine, post-vaccine stage where people will take a call on whether work from home is a permanent norm or not? And if you hear what Satya Nadella said about the whole psychological impact of people permanently working from home, compared to what Twitter is saying, where we are okay with letting people work from home permanently, that could shape trends in terms of how work from home impacts commercial real estate going forward.
If I could get you on the lending aspect of things, moratorium is particularly high among NBFCs and HFCs, and a large portion of the moratorium mix is skewed towards developers. That is what our channel check seems to be indicating. What kind of impact could this have on asset quality, the increase in NPA that you forecast going forward?
Is this question to me?
Nidhesh, yes, the question is for you.
Yeah. So I think if you look at the sector, commercial construction finance segment has been already under pressure. The two incremental segments which are coming under pressure is one is lease rental discounting. There is if we speak to any of the companies, all of the companies are talking about cost cutting, and first line item that they are talking about cost cutting is rental. All of them are saying that they will renegotiate rentals, and the rental may come down by 10%, 15%, 20%. So work from home may not have that much impact over a long term. We don't know, but definitely the rental income on a commercial real estate is likely to come down by 10 to 20%. Second segment, which is likely to see decent increase in delinquencies, under construction housing loans. People have bought these houses. There has been a construction delays. Construction delays are likely to increase post COVID-19. Some of the projects which were already under stress, they may not see light of the day. So I expect there could be a significant increase in delinquency in that segment. Also, under construction housing loans, SARFAESI Act is not applicable, and the recovery from those loans will be very, very negligible. Given these two trends, I think asset quality is likely to deteriorate for housing finance companies as a whole. We have already been seeing pressure both on retail asset quality as well as on the wholesale asset quality. So if you look at the likes of HDFC, this quarter itself, in both segments, asset quality has deteriorated. I think those trends will continue to inch up going forward. And for other housing finance companies, the trend are in fact much more severe, and they are likely to see significant increase in asset quality over the next few quarters. Coming to moratorium, I think during the first phase, lenders were also quite lenient in terms of giving moratorium. In the wholesale segment, we have seen almost 50 to 80% of the book under moratorium, while on the retail segment, the percentage is between 20 to 50%. I think in the moratorium 2.0, where 3 months additional time has been given, lenders will incrementally be more vigilant, and moratorium percentage, in my view, will come down across both retail as well as wholesale segments. As we can see that in some areas, economic activity is picking up. lenders also have much more time to decide which player they will like to give moratorium, which they will not like to give moratorium. So I think moratorium percentages are likely to come down, but asset quality trends will deteriorate in coming quarters.
Okay. Chintan, what about residential? What's the trend over there? Are there particular segments, geographies, or, for instance, the affordable segment that's likely to pick up? Because there has to be an impact of this post-lockdown as well, with more people wanting to, that sentiment being revived of wanting to own your own home.
No, I agree. I think the intent would be for owning their own home, and when you especially have kind of joint families, and a number of people kind of in a smaller area, the intent going forward would be to own a home. The only thought that I have is, will that be the first step that people will take? Because owning a home requires a lot of capital, and in an uncertain time frame that we are in right now, does owning a home become a priority? Having said that, I think in the long run, I think residential will definitely do well, because I have personally believed that in India, demand will always be there, given the whole population base that we have, urbanization that's happening. So demand for residential will be there. However, I see a major shift happening in residential going forward, specifically from use of technology and the design and the layout itself. So if work from home is the norm going forward, if that's the assumption, then the design has to include some sort of an area which is dedicated for people to work from home. Second is, if people cannot physically visit to see so many locations before a buying decision is made, can technology play a big role? And I believe technology, starting from design to construction to selling to financing, I think technology will play a major role going forward in the residential segment.
Okay, how interesting. And Nidhesh, let me bring you in on that, and also from the financing point of view, the kind of credit demand that you're anticipating for the residential segment?
So we are expecting very muted disbursement growth from the financiers. We are building almost 25-30% decline in disbursement in this financial year, primarily because due to lockdown, first quarter is completely washed out already. And we expect the demand to pick up slowly. We expect demand to get normalized only after the festive season. So first 2 quarters will be very, very muted in terms of disbursement growth and housing demand, which will lead to a sharp correction in loan growth, disbursement growth for most of the housing finance companies.
All right, gentlemen, we'll have to leave it there. Thank you so much for joining us this morning. Good to have you with us.